Welcome to the Stock Play of the Day. Today we're going to take another look at gold. Specifically, we're going to look at the gold ETF, GLD. We'll discuss, should we pass or should we play? Hello everyone, I'm Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, I have a chart of the S&P 500 index up. We have specifically a 3-month chart, and obviously the markets are going a little crazy today. So what are your thoughts on what's going on?
Yeah, I mean, it's been a wild couple weeks, and this morning that trend really did continue. The futures were halted overnight. They declined 5%, and that's where the exchanges halt that action. And then they opened up down 5%, and they kept sliding to the 7% mark, where the NYSE and other exchanges are required to once again halt all trading on the exchanges for 15 minutes. And once they reopened shortly after the close, after that 15-minute break, we did see there has been a little bit of a rebound since then. I think the markets right now, as we speak, are about down, the S&P 500 anyways, about down 5%. So still a pretty swift move down. What's driving the action today? Well, it's actually oil prices. News over the weekend, OPEC and Russia couldn't come to an agreement on production cuts as oil prices have come under pressure in reaction to the coronavirus and the slowing growth that is occurring from that, especially in regions like China. So they couldn't get their act together and come up with an agreement to once again cut production to stabilize prices. So when that broke up over the weekend, Saudi Arabia came out and said they're actually going to cut the prices further on their oil that they're selling to the US, to Europe, and to the Far East, really to gain market share from Russia there, but also to put pressure on US producers who have really been taking market share from both Saudi Arabia and Russia. So oil prices plunging 30% overnight. Right now, they're down about 20%, 19-20%. So a really big move for one day. I think it's the worst day since 1991 for oil markets. And that 1991 was the Gulf War we were going into at that point in time. So these are dramatic moves, and it's going to have a dramatic impact on the markets overall, because while the energy sector is only a small portion of the S&P 500 index, it is a much bigger percentage of our economy. So we would expect there to be some softness in CapEx spend, as well as production here to be announced in the U.S. And so that's going to impact the companies and the people that work for those companies in the oil patch. So that's what we're seeing is driving action this morning in the S&P 500. But I wanted you to take a look at those levels. We've been watching a couple different levels within the S&P 500 over the last couple weeks. But before you do that, I would just once again remind our viewers that we do take your questions live at the end of the show. So make sure you write them in the right-hand side. There's a box there. We're very excited to hear from you and answer your questions at the end. So don't forget to do that. But Brian, what's going on with the different levels from a technical perspective that we're seeing in the S&P 500?
All right, so now I have the chart up in the S&P 500 index, and it's interesting. Now, we haven't even touched this chart since we had the big downturn. And first of all, we broke through this little trading range before the big downturn, and that was the start of the collapse of the S&P 500 index. Then we came all the way down, and we have a real strong support line down here at that October low at the beginning of October. And we came all the way down, touched that. We saw some capitulation in the VIX index. We kind of spiked up towards that 40 level, a little above 40. And then we did get a little bit of a bounce back. But now we've came back. We've broken through that support on the downside. And on the VIX index, we've actually broken up in the VIX index. And we're going to talk a little bit more about that a little bit later on. But it's interesting to see this in the SPX. It's a little bit nerve-wracking that we broke through that support from October. But if we look at the NASDAQ, we haven't quite had that down move in the NASDAQ like we have in the S&P 500 index. It's a little bit stronger here. But I have highlighted the 200-day moving average on this chart, and that has kind of acted like this October low in the S&P 500 index. It's given a little bit of support. We see we had that little bounce there, but the October low is all the way back here, all the way down to this level. So we did break through the 200-day, but that just kind of shows you that the NASDAQ has shown a little bit more strength here versus the large cap index.
Yeah, it really has. And that's a notable observation, Brian. The fact that the NASDAQ is actually showing strength versus the large caps, just repeating what you just said to let that sink in for our viewers. What that means is you usually would expect to see investors flock to the large cap stocks with strong balance sheets and strong cash flow in periods of uncertainty like this and periods of volatility to kind of hide out, as they're oftentimes considered a little more safe from that perspective. But you see that the NASDAQ is actually holding up better. And also, Brian, I would note that on the days that we do have up days, and we've seen both sides of the trade here, especially last week. I think we swung between 1,000 points up or down each day. When we do see those green days, you do see cyclical sectors like the tech sector especially lead, because it shows investors still have faith in the growth trajectory that they're able to create without relying on necessarily economic growth. So I think that when we do get past and once we have a better understanding of what the coronavirus impact is going to be on the economics here and abroad, as well as what it means for earnings, that you're going to see the NASDAQ and some of the cyclical sectors really be able to lead us higher, and probably sharply higher, much faster than we saw before. So I think it's very notable. Also, you mentioned the VIX crossing 50, Brian. When was the last time we saw that happen?
Well, right. Okay, so now I got a chart of the VIX index up, and this chart's going to go all the way back to the financial crisis, 2008, 2009. And the 50 level, I think, is a very important level. We talked last week about the fact that we ran up to about the 48 handle. We didn't quite hit 50. I'm going to highlight it a little bit on my graph if you can see my cursor. And then after that, we actually had a little bit of a bump, a little bit of a pullback in the marketplace to the upside. Now, what's interesting to note here is that there's been 4 times since 2008, 2009 that we've came close to touching that 50 level. The 50 level seems to be a significant level in the VIX index, in that if we hit it and we bounce back, that's usually a good sign for the marketplace. But as opposed to going all the way back to 2008, 2009, where we hit it and we exploded through it and stayed above the 50 level in the VIX index. The fear index is another way to say it. And I should probably emphasize too that what is the VIX? The VIX is based off of the implied volatilities in the S&P 500 index option contracts. So the more people that rush to the S&P 500 index options for protection, the more they drive up the VIX level. And that's where it gets the name of the fear index. Okay, so with all that said, today we broke through that 50 level. We're trading right now at about 51.52. I think the high on the day, let me put it up here so far, the high was 54.39 according to my chart. So if we broke through it, and that's a factor, but if we actually stay above that VIX level, I think if anything, it's the exact opposite of actually getting a bounce off of it. We look at the S&P 500 index, you combine the fact that we broke through the VIX level, the 50 level to the upside, and then we also broke through that October low to the downside, and those two things are a little bit scary in the marketplace. So I actually went back, Lindsey, and I pulled up the S&P 500 index of basically the start of the bull market after 2009. And I got rid of all the noise on this chart. There's no moving averages. There's nothing else. Not a lot of people have talked about this trend line in general because we've got beyond it. We've gone into a lot of different channels much higher. And obviously, if you go all the way back to, once again, that October low, you saw a big, strong move up in the S&P 500 index. But if we go all the way back to the start of the bull run in 2009-ish, and we got a touch right here, almost got a touch here, but that kind of signals an area that's potential that the market could pull back and still be within that bull run, still be within that channel that would start it all the way back. And that makes you a little bit nervous because it's just showing that there is some potential room to the downside still in the S&P 500 index. So we broke through the October low. We got a breakthrough through the VIX on the upside, going all the way back to this channel. That's right around, I'm going to call it 2,400. It's not an exact science. We're looking at a monthly chart going all the way back to 2009. But I'm just saying that level is not is within the range of the downturn here in the S&P 500 index. But we're getting a little long in the tooth. There's a lot to talk about here, obviously, in the S&P 500 index. Let's jump into the stock for the day. The ETF in gold, GLD. I have a chart of that up right now.
Yeah, thanks, Brian. Let's definitely dig into GLD. It's a good one to look at, especially listening to your explanation of what's going on with the VIX and the potential that there could be more downside in the market coming. Gold has historically been a safe haven, excuse me, in periods of market uncertainty or market volatility. Also, in periods where the Fed is cutting rates, central bankers are increasing monetary action, and if fiscal spending increases, gold is definitely a good place to be. So if we take a look at GLD, and we covered this a couple weeks ago, because what we saw on, I think it was Monday the 24th, what we saw was that gold had peaked at a 7-year high, just under $1,700. And we saw a 5% pullback from that range. And, the rumors were that people were taking profits so that they can cover their margin calls, or just simply taking profits from some of the winners, because gold had advanced 31% going into that Monday, February 24th, from May the prior year. So that's a really strong run for gold in almost a year. So we saw the 5% pullback. That's when we said, hey, this could be an opportunity to get involved. And so what we saw last week was gold advanced again about, almost 7%. Again, back to that level, we're seeing that same level at 1676 on the gold metal, on the yellow metal. That seems to be a level of potential resistance right here. A tougher level for the metal to get above, because we're actually seeing gold in the red, even though the market is down around 5% and the VIX is up. We also have, by the way, the dollar down about 5% from its recent high on February 20th. That's a good thing for gold. So the reason we think this thing can continue to go higher, even though it's at levels not seen in more than 7 years, is really because of the monetary situation. We think, the market is pricing in another Fed rate cut next week when they meet, of 25 basis points. If we get that, we get more later in the year, that makes a good case for gold. Again, fiscal stimulus, you see a lot of commentators talking about that on TV these days. They want to see some sort of fiscal response from President Trump and Congress to really combat what is expected to be a slowdown in economic behavior for certain sectors of the economy. And if we get that once again makes the case for gold, because it hurts the value of the dollar, just like cutting interest rates from the Fed does. So when the dollar declines, that makes the case for gold as well. It's a hedge in inflationary times. So that's once again why we're looking at the GLD as an ETF, a way to buy gold instead of buying the metal outright. The ETF does actually hold metal, holds the gold. So you're getting you're really it's a good way to buy into the metal and get exposure to that type of commodity. So Brian, I know you looked at a trade a couple weeks ago for us in the options market with the GLD. What are you thinking about today? How's that differ today versus a week or so ago?
It's going to be fairly similar. We're in the same type of marketplace. We're looking for a little bit of a break to the upside. And with option trading, we can define our risk. We can say, well, this is going to be our max risk. This is our max reward. So we're going to pay a lot of attention to the risk reward ratio in the gold trade that we're going to look at today. And I'm going to emphasize it's a paper trade. We're only trying to learn here on the stock play of the day. So if we look at our paper trade for this week, it's going to be a long call spread. Very simple. A lot of people will call it a bull call spread, but we're going to pay a net debit. We're going to pay a net debit for this trade, and that's going to be our max risk on the trade. And we're going to look the ratio that I'd kind of like to get when I'm doing a speculative trade like this over the short term, looking for that short term pop through the resistance to the upside. If I'm looking at that type of trade, I like to use a long call spread to define my risk. I'd like the goal of getting a 1 to 2 risk ratio, and that I'm paying like $2 to make 4, or I'm paying $3 to make 6. I like to keep it in that ratio, and you can do that with long spreads, and it helps you manage your risk. But how you also adapt your strategy to it is up to you. But I like that type of risk reward when I'm looking at a speculative trade based off of a chart, hoping for a breakthrough on the resistance level to the upside. So let's get into that trade. So this is inside the options playbook, what I'm showing you right now. This is a profit and loss graph at the expiration on just a generic long call spread. Let's look at a real long call spread now. All right, so we have the spider. Here it is, the spider GLD. Right now we're down 75 cents on it on the gold trust, 156.76. We're going to go out about 18 days. Right now the normal monthly expiration is 11 days away. I want to give it a little bit more time to play out. I'm going to go out to the 18-day level, and that's the March 27th expiration. Now, if I'm looking at this trade, I need a few more strikes to the upside. I'm going to add some strikes inside the Ally Invest option chain. On the left-hand side, we have the calls. On the right-hand side, we have the puts. Here's the actual quote on GLD. And I'm going to pay attention to the put side on the call that I'm buying. Why is that? That kind of shows me the time premium that I'm buying. It's not an exact science in the real option chains, but it gives you just an estimate, and that's all we really need, because I want to try to sell approximately the same amount of time premium that I'm buying. That makes life a little bit simpler here. So I'm going to buy the 156 strike call, a little bit in the money, and that's highlighted by the fact that we're in the blue option quotes as opposed to the black. And then we're going to look to sell something that has about that amount of time premium. And if I go up and look at the 160 strike call here, that's trading at 277 by 288. Now, it's not as much, it's not over $3, but it's close. So I'm going to have a little bit of exposure to the time premium. And the reason why I'm really concerned about that is that implied volatilities are elevated everywhere. And if you have elevated implied volatilities, you're going to have elevated option prices. You're going to have elevated everything in general. So because of that, I'm going to pay attention to that. I'm going to sell the 160 strike call here. And our official paper trade for this week, if I pull up the option strategy workbench, and we'll get the profit and loss graph up here too. Let me zoom in on that a little bit. All right. So in this instance, our midpoint is $1.50. So we're doing a 4-point wide trade. We're paying $1.50 for that. That $1.50 is going to be our max risk. Just like if we bought an option outright, if we just bought this gold option outright, we'd be paying around $4.30 for it, which I'm highlighting on the screen. And here, though, by buying one option and selling another option, we greatly reduce the cost down to $1.50. So now, 4-point wide trade, and we have $1.50 of risk. You take 4 minus $1.50 in this instance, and you have $2.50 worth of upside on that trade. So that's my risk reward. If I'm looking to do the trade, I would like it to be $1.50 and get $3, but the market's just not quite there. You take what the market gives you. So if we go down and look at the profit and loss graph of this, then we see this is similar to the profit and loss graph you just saw inside the options playbook. The dashed line is at expiration. But in here, because we have the value of real-time quotes inside the option tools here at Ally Invest, you see the colored line is as of right now. So here's part of the reason why we're looking at the expiration that we're looking at is that if we do get that move up to gold right away, like instantly today, we go all the way up to the 160 level. In that instance, you're going to be profitable on the trade, but not as profitable if you waited till expiration. And I'm going to show you this. I'm going to remove some days to expiration in here, and I'm going to regraph it. And you're going to see that line come very close to that expiration line. All right, and if we go with, let's go with 3 days remaining to expiration, right, and graph it. Now we're a little bit further away, but you can play with different scenarios in here as to if your forecast is correct, and if it's correct closer to expiration as opposed to right away. So obviously, if we just bought a call, we would like that to happen right away. Spreads are a little bit different, so you got to be way more selective on the expiration date that you are choosing. So let's recap our paper trade for this week. I'm going to go to the Ally Invest large trade ticket here to kind of highlight some things. So we're looking at the March 27th expiration. I think it was 17 days away. The market's already moved. The midpoint was one, and that's the problem with using live quotes, right? The midpoint was 150. Now the market's already at 180. That's a pretty big jump in about 2 minutes, actually. So I guess the midpoint is 180 on it. That's going to be our maximum risk. Maximum upside is going to be the $4, the most that it could trade for. So now we're risking 180 to make 220. That's not quite as good of the ratio that we had, but such is life. The markets move, and that's when we do tape the stock play of the day. All right, so we got some listener questions. So we got quite a few that have been chatting it up in the chat box. Please feel free to add some questions if you got them right now. And I'm going to start with the first one. This one's for me, Lindsey. It says Goldbug 987. Brian, what are your upside and downside targets for this trade? All right, well, I mentioned the risk reward, and that was kind of the way that we looked at the setup. I like to do a setup where if I'm paying $1.50 for the trade, I'd like to be able to make $3 on the upside. I'm paying $1.50. I want to be able to make $3. We had $1.50 and we looked at $2.50 for the upside when the trade was initially put on. It wasn't a bad risk reward. We got to take what the market gives you. But if I look at it that way, then I don't mind just letting the trade run. I got $1.50 of risk. I know my upside. I know that I'm going to make more if the forecast is correct than I'm going to lose if the forecast is incorrect. But you can also take a different approach to it. You can say, okay, whenever I'm doing these type of trades, I'm only going to allow myself to lose, I'm going to pick an arbitrary number, 50% of what I paid for it. And some people will take that approach. And if I do that, though, then I'm going to have a tendency to get out a little sooner on the upside. So if I say I'm going to lose 75 cents on the downside because I paid $1.50 for this, well, then on the upside, I'm not necessarily looking for the max gain. If I lose 75 cents on the downside, I want to make double that on the upside, $1.50 then that would be. Paying $1.50, want to make that $1.50. If I lose, I'm losing 75 cents on the trade, which is 50% of the trade. Now, if I do that trade and I'm approaching it that way, I want to stay consistent with it on the risk reward, all right? So it's all up to you, but the big thing here is to have a plan and then stick to that plan. All right, Lindsey, it looks like I got another question here. Actually, this one I think is going to be for me also. Ron, and I won't use Ron's last name, what about a 55.50 VIX credit spread for March 18-20? Seems like you have 4-1 in your favor. All right. The VIX is a different beast. I don't know where it's going to go, and we're in new territory in the VIX. So right now, I would definitely wait until we see the closing price of the VIX and see where we end up at. But I'm going to leave that one up for the speculators. The VIX is such an odd beast to trade. I don't mind it, but I really want to see where the VIX ends up at today. All right, do we have any more questions here? Bear Trader. All right. I don't think that's their real name, so I don't mind saying Bear Trader here. How do you think coronavirus and recent volatility could impact earnings projections? All right, and I'll leave that one for you, Lindsey.
It's the question everyone wants to know the answer to, I think, and that's what is causing probably a little bit of anxiety in the market right now is that we don't know what the impact is going to be on earnings or on economic growth here domestically or globally. And we know one thing that we do know is that we haven't seen the worst of it here in the U.S. yet. So it's hard to make that prediction. You've seen some of the earnings estimates come down a little bit, but not to a significant extent. We were looking for the S&P 500, we were looking for 7.8% growth in 2020. That was on January 1. That's moved down to about 4.8%. So 300 basis point move, which is a big move in a short period of time. And that move, along with the move in the market through this morning, helps get us to a more normalized PE multiple of just over 16 times, which is in line with the long-term historical average forward PE multiple for the S&P 500. So that's a good thing. But the question mark really is, what are earnings going to look like for 2020? The way I see it, I think first half numbers or second quarter, the second and third quarter numbers are going to have to come down pretty dramatically. But you could see that rebound at the end of the year. It's hard to say. Once we have more information on what the economic impact's going to be, we'll be able to answer better. But so for now, just keep a close eye on all the data that we get.
All right. Well, no more further questions. Thank you again for joining us for the Stock Play of the Day. Please make sure that you click subscribe and ring the bell to get all the alerts so you get all the reminders for every Stock Play of the Day. That's usually every Monday. Make sure you do that to get the reminders, and see you same time next week.